we are seeing some signs of things stabilising, as you said, which is good. Like, we'll take that. We like it. But the labour market really does lag what's happening in economic reality. The economy needs to strengthen, and then it's going to take, I think, a lot of time for that slack to be removed and for us to return to full employment. Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou and welcome back. Another week, another episode of Markets, Mystics and Mayhem. This week, we're going to talk about the first axis of the famous Phillips Curve, and we're going to talk about the labour market slack in the Kiwi economy and how that's feeding through to the other side, inflation, which we'll talk a lot more about in the next episode. So kind of a double episode, kicking off with the labour market. We had data out today. MJ, you were in lockup. What happened?
You know, this one, there weren't really many surprises. All the data kind of came in line with our forecast, similar to the Reserve Bank's forecast. So we have unemployment, the unemployment rate climbing to a 9-year high of 5.3% from 5.2%. Employment over the quarter was flat as expected as well. So it looks like things are starting to stabilize. It wasn't a terrible report. Unemployment is at a 9-year high, but it wasn't a necessarily terrible report. It just shows you that there is still a lot of slack in the labour market. The underutilisation rate, which is a broader measure of unemployment or just spare capacity in the labour market, that lifted to 12.9%. So things are soft, but it does look like they're starting to stabilise.
So the unemployment rate 5.3, underutilisation 12.9. What's that difference?
It could come down to things like underemployment, where people are in work but they're wanting more hours, or other things that underutilization rate is just a broader measure of that untapped potential in the labour market. Yeah,
and I think that's a really good rate to look at, actually, because the unemployment rate's one thing, but we've actually seen hours worked drop quite a bit over the year.
Yeah, so that was one kind of glimmer of good news in the report, was to see that the hours worked lifted 0.9% over the September quarter, and that breaks 7 straight quarters of it being in decline. And over the year, though, it's still down about 1.4%, but it's much better than what we've seen in previous reports, where it's down 3%, which is very much those kind of GSC type levels.
Yeah. It's interesting, though, because I guess hours worked is usually the thing that probably comes back first. We usually say that the reason the labour market tends to lag the broader economy is because, firms hold on to their staff for as long as they can, so they start to cut hours first. So maybe now we're seeing part of that stabilization story that we're seeing is, okay, hours are being put back on the table, which is the first sign, and then maybe employment growth comes from there. But right now, as you said, employment growth is flat over the quarter. Yeah. We did see some downwards revisions to employment growth earlier in the year, though, which overall still put employment, the annual rate, down at 0.6%. So contracting 0.6% over the year, which is, still pretty significant. I think it equates to about a net 19,000 jobs lost over the year. So that does still tell you that there is that slack there, even though we are kind of reaching this stabilization point. There is probably still quite a bit of pain out there.
Yeah, there's a lot of slack, but you're taking the glass half full approach. Always.
Yes.
Things are stabilising. And so what does it mean for your forecasts? I mean, you're looking at the unemployment rate easing or falling, if you like, over next year.
I think we're probably close to the peak in the unemployment rate. Again, a lot of it kind of depends on, which is why looking at the underutilization rate is more of a pure measure, because the unemployment rate also has, the labour force participation rate kind of affecting whether it goes up or down. And we've seen that continue to correct lower. So it's kind of keeping a cap on the unemployment rate. But if we're looking at other metrics of the labour market, like employment growth, it's looking like it's starting to turn. So we've had monthly filled jobs data, which is based on tax, blah, blah, blah. But it's a more frequent kind of update on the labour market. And the more recent months have shown that filled jobs are starting to grow. It's usually overstated, but it's looking like things are starting to turn. So that kind of gives you confidence that next year we'll see that employment growth start to pick up into next year when the economy's picking up as well.
Yeah, and to step back, you look at the GDP numbers and economic activity. The economy's contracted more than what it did during the GFC, right?
Mm.
But the unemployment rate peaking at 5.3 is significantly better than, what was it, 6.5 or something like that during the GFC.
Mm.
What was the underutilisation rate back then, do you know?
Not off the top of my head. High.
Yeah, it was high.
It must have been like double digits in that time.
Yeah, it would have been.
But our participation rate now must be quite a lot lower than back then, right? And what did it fall to today? 70.3, down from 70.5, and that's been an ongoing trend. Part of it was a normalization, during that post-COVID, everybody coming into work and higher wages attracting workers back in. Some of that was a normalization, but part of that now is just that fatigue worker effect playing through. But that's kind of tempering your rise there, which is interesting because I know when you called from the lockup and I could hear Jarrod talking to you and he was saying, it sounds pretty good. But when I saw it come up on Bloomberg and I saw that the participation rate had fallen and the unemployment rate had risen, I actually thought, oh my gosh, this looks really weak.
Yeah, I was with you. I was like, this looks weak. And then MJ's like, no.
But
it's okay.
I think where the really, and you've already mentioned it, but where the really good spark of news was in that total hours worked. And I think that's probably just your leading indicator there as well.
Yeah, things turning around.
And I think, another kind of leading indicator, which we might be seeing is that splitting employment down to the full-time workforce and the part-time workforce. We've seen a bit of a shift there. So over most of 2024 and earlier this year, the full-time workforce was contracting for, the entire year last year. Now it's starting to, you're seeing some employment growth in the full-time workforce, whereas in the part-time workforce where they kind of held up for most of last year, they were still growing. That's reversed and now they're starting to contract. I think they had their second quarter of contraction. So maybe it's that, employers are kind of looking ahead and looking at the outlook and going, actually, I feel confident. I feel like I'm going to have the capacity to offer, these full-time hours. And so you're seeing that growth in the full-time workforce as opposed to the part-time coming off now. That might be a sign too.
I think that's a really good point because, like you say, employers cut hours before they cut heads. Maybe they're putting people back onto full-time work, having been through most of the pain and now getting back to more normal sort of levels of activity. That could definitely be a positive. But for me, I think that participation rate is telling us a lot as well. And when you scratch beneath it, it is that younger demographic that's been hit pretty hard, right? What was it, like 50-odd% down to 45%?
Participation,
which is, quite low for, people aged 15 to 25, I think.
Yeah.
24 actually.
I know it's 24.
You're just saying that because I thought you were saying that because I feel sad that I'm no longer in that age category.
Oh, right. Are you no longer a younger worker?
No, I'm 25 now. It's really, it always gets to me when I'm starting to analyze the data and I go, I'm not part of this group anymore. But on those age 15 to 24, that is where we're seeing, I think, the highest unemployment rate lifting from 13.1% to 15.2, so pretty significant. No wonder their participation's kind of coming off. It's really discouraged workers. And something interesting that we saw is that a lot of, these workers aren't necessarily going back into training and education. We saw that, I think there was a stat saying that a lot of women in their early 20s were actually going, a third of them were going back into sort of caregiving roles.
Yeah.
Which we had a little interesting conversation because we thought, fertility rates haven't really climbed too much. So we're wondering whether that sort of aging population story is maybe starting to have an effect, and it's, people around my age maybe having to look after grandparents or elder family. Yeah,
potentially. See how that plays out in coming years as well.
Yeah. But I guess where this all kind of hits the road as well is what's happening on wages, right? Because that's going to feed through that extra slack. We're seeing it play through into lower wages, and that's going to be crucial for monetary policy decisions and the inflation outlook. So what's happening there?
Yeah, we've seen just that continued moderation in wage growth. It's fallen. The private sector labour cost index that fell to 2.1% from 2.3%. That's off its high of 4.5%. It follows inflation just continuing fall. So there's that element to it. There's also the element of just more slack in the labour market. So that kind of bargaining power has moved over to employers now with, no longer needing to kind of fight for employees anymore. It's not like during COVID where that was very much the case. Also, what's interesting is the distribution of these pay rises are changing as well. There's an increasing proportion that aren't receiving a pay rise at all. Whereas at the same time, you've got a smaller share who are receiving pay rises of, that 5%, which would used to be really the favoured rate. It used to be like 44% of those who received an increase in pay had a pay rise of more than 5%. That share has now fallen to just 11%. Most people are now averaging a pay rise around 2 to 3%, which is in line with inflation.
Yeah, exactly. My wife works in HR and she's asking me all the time, what's the inflation rate now? I'm like, well, it's at 3. And then she's like, well, where is it going to be in the second quarter of next year? It's like, well, let me ask MJV, but it's going to be closer to 2. So basically when they go to their bargaining and when they're talking to their unions and that sort of stuff, it's, the CPI number is generally the one that they look at, or maybe the house price.
Household living cost index.
Yeah, well,
that one,
got it
which
out.
we're talking about in the next
episode. Exactly.
Yeah. But I think that's what the Reserve Bank will take away from this. Again, we're seeing inflation running at 3%. It looks really high, but these kind of indicators show that inflation in the medium term should be, should go back to its target of 2%, potentially below that, because there's just so much slack in the labour market. It's not generating any. You can't say that it's a source of inflation anymore. That was very much the case a couple of years ago, where it was very hot, very tight, and you saw wage growth lifting. But with that very much having reversed, that medium-term outlook is very much, limiting any domestic inflation.
Yeah. And I think the main message here is that we are seeing some signs of things stabilising, as you said, which is good. Like, we'll take that. We like it. But the labour market really does lag what's happening in economic reality. The economy needs to strengthen, and then it's going to take, I think, a lot of time for that slack to be removed and for us to return to full employment. So it's going to be a slow recovery over 2026 that still requires policy support.
Yeah, exactly. We still need more stimulus to kind of eat away at that slack in the labour market, eat away at that spare capacity still in the economy. Just keeping settings as they are now, just risk delaying that recovery even further.
Well, that's what has happened already, right? Yeah, they didn't cut enough last year. They didn't cut enough this year, and we're still waiting for full-blown recovery to take off. We're seeing some green shoots, nice, great, some stabilisation. Yeah, really? 2 years? 2 years? Too late? Cheers. So what else? What else was in the labour market that we should think about? Is there anything around industries or...
When you're in the lockup, all you're looking at is just the headline and the just the headlines really, because it's really fun actually being in the lockup because, well, it's not fun. It feels like an exam because you go in with your forecast and you go in with what you think will happen, and then you have to wait. They give you the folder of all the sheets and everything, and it's like, don't touch them until 9:45, and then you have to go to look at it. So there's no room for be like, oh, this is kind of fun to look at industries. It's all just the headline.
Just taking on the headlines.
But you usually notice it if it's something that's really bad or really good.
Yeah. And this time, I guess the feature has really been around that demographic, around age and the spread of
as it has been this entire sort of cycle.
Yeah.
But also not very unique to this cycle. I think we always say they're like last in, first out.
Yeah.
Yeah. But if I was to take a stab, it's probably construction and those kind of interest rate sensitive sectors that have seen poor economic activity. So that naturally you'll see all the job losses or any weakness in those areas as well.
Yeah, and speaking of construction, the presentations I gave at the Master Painters and the Master Builders conference was quite interesting. They fly in these apprentices from around and there's an Apprentice of the Year award. And, talking to one of the owners sort of turned to me and said, we'll probably lose half these people. So there's your young demographic who might not pick up the job or the pay rise that they want here, so they're off to Australia. Right, so there's the slack in the labour market and the fall in the participation rate.
Exactly.
So Kiwi Aussie.
So we had a bet with traders. Now, traders are supposed to be good at picking levels, getting in, getting out, making money. That's what they do, but they don't seem to beat the economists.
How many times have we won cake from them now?
Yeah, I know. I'm a bit worried about our blood sugar levels being too high. But yes, we won another bet today, which was kind of cool. We had a bet with our traders that the Kiwi Aussie Cross would fall below 87. And while you were in lockup, it did just that.
Did it while I was in lockup?
Oh, no, sorry. After.
When you called.
Okay, I wish I... Okay,
while
I was
you're on
say,
your way back.
I don't want to miss it.
Yeah, you didn't quite miss it. You were watching. I know you noticed it pretty quickly. It was pretty good. I
mean, we've been watching it for like the last few days, really, because it's been flirting. It's been really close to the 87 level.
But the market perceives the data as being soft, obviously, for a while.
Yeah.
And then you obviously triggered a few stops. I think as it got close to 87, people probably capitulated on their view, and it just went bang.
Yeah.
It's above 87 now, and the traders are telling us that, they're right. Well, no, you've stopped out.
Now might be a good time to go long.
Yeah.
That's our next recommendation.
Maybe we go the other way, just to show them that we can do it both ways. Yeah, good call. All right. Are we done for this episode?
How long has it been? 60 minutes.
It's a short, sharp 15 minutes.
That's fine, because the other one, they're kind of like a
Was there
two-part.
anything else? Honestly, it was a boring report. There's nothing else to say.
Oh,
Can you keep that in?
Do you want to?
Keep that in. Because it starts off, it's actually a lot of fun. No, it's not a lot of fun. It's an exam.
It's boring.
And then now it's... Oh my God.
Boring.
Jekyll and
I
Hyde
remember
over
when
here.
I called you in the lockup, I was like, and you were like, anything else? I was like, there's literally nothing else to say. It was all just like as expected, no surprises.
Well, that's good. A boring report can be
good. A boring
good.
report is a good report.
Particularly
in terms of
the words that came out of your mouth when I was trying to, because it looked from our point of view
I know,
to be
you were
soft.
like, you're really trying to figure out why it was soft. And I was like, it's not that soft.
Yeah, not that soft.
Yeah.
I
I
guess
think
it's
it's because we saw the...
I think we saw the annual change in employment.
Yeah.
But it took a while for the revisions to come through.
Yeah.
And we were saying there must be some kind of revision here, because
Yeah.
it was the quarterly employment growth was as expected.
Yeah.
But I think it was just the fact that there was the fall in the participation and
It's just
also the
against
rise in unemployment.
expectations, yeah.
And then also the fact that the employment annual one looked a bit rough.
That was what
Yeah.
got
Yeah.
our attention. Okay, I think we've come to the end of another episode. Thank you for tuning in. Please like, subscribe, follow, put comments below, and please join us next week when we talk about inflation, but through a different lens. We're done. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.